Something unusual is happening in the precious metals world right now. A dramatic move from gold to silver, and it is happening quietly enough that most people haven't realized how significant it could be. Across coin shops, bullion dealers, and jewelry markets from North America to Asia, investor behavior is shifting in a way we rarely see outside of major financial turning points. Buyers who traditionally defaulted to gold are increasingly choosing silver instead. Not casually, not as a novelty, but as a deliberate strategy. Inventory patterns are changing, retail demand is rotating, and one of the oldest valuation signals in finance, the gold to silver ratio, is widening in a way that historically precedes big repricing phases. But here's the key question. Is this just another short-term fluctuation, or the early stage of a broader structural shift in how everyday investors think about wealth protection? Today, we're going to unpack what's really happening, not through hype, but through mechanics, psychology, and real-world behavior, so you understand the forces driving this dramatic move from gold to silver. To understand why this shift matters, you have to zoom out. For centuries, gold has held the crown as the ultimate store of value. Civilizations trusted it. Empires hoarded it. Modern investors still treat it as monetary insurance. Silver has always lived in gold's shadow. Cheaper, more volatile, but deeply connected to gold through pricing relationships and market cycles. That connection is tracked using the gold to silver ratio. Put simply, it measures how many ounces of silver equal the price of 1 ounce of gold. Historically, this ratio expands and contracts based on investor sentiment, industrial demand, and economic stress. When the ratio stretches quickly, it's often signaling that markets are reassessing relative value. And right now, that reassessment is driving behavior we can see happening on the ground. Not in theory, but in real transactions. Let's start where markets become tangible: retail bullion. Across multiple regions, coin dealers are noticing a pattern that feels different from typical volatility cycles. Customers walking in aren't primarily selling precious metals to lock in profits. They're accumulating silver, sometimes aggressively. Dealers report faster turnover in silver coins and bars compared to gold products. This isn't a rejection of gold. It's a recalibration driven by accessibility. Gold's price has climbed into territory that feels psychologically heavy for many investors. Even those who understand its long-term value hesitate when entry costs rise. Silver, by contrast, provides a way to own physical metal without committing large sums of capital. And when markets create accessibility gaps, behavior adapts quickly. That adaptation is unfolding in real time. This rotation isn't isolated to one country. In emerging markets, where precious metals ownership often blends tradition with financial planning, buyers are adjusting how they preserve value. Families that once defaulted to gold for savings are exploring silver bars and coins for practical accumulation. Wholesale demand patterns show growing interest from private investors and smaller institutions looking for exposure to tangible assets without gold's capital intensity. These decisions aren't driven by speculation alone. They're responses to broader uncertainty. Inflation pressures, currency fluctuations, and geopolitical tensions that push people toward assets they can physically hold. Silver's affordability widens participation, and participation is fuel for market momentum. Markets don't move purely on spreadsheets. They move on perception. When investors start labeling gold as expensive, even if fundamentals support the price, the psychological barrier becomes real. People still want protection. They just seek a form that feels attainable. Silver becomes the bridge between desire and affordability. And once a narrative forms, silver is the accessible alternative, behavior accelerates. Momentum builds not because silver replaces gold, but because it expands who can participate. That's a powerful psychological shift. Historically, markets driven by expanding participation can move faster and further than fundamentals alone would suggest. And if you promote finding value in this kind of breakdown, understanding the structure behind market moves instead of reacting to headlines, consider subscribing. This channel exists to decode financial behavior and economic signals so you can think ahead, not chase trends. Now let S go deeper, because the mechanics behind Silver OS appeal are just as important as the psychology. Silver occupies a unique place in the commodity world. Unlike gold, which is mined primarily for monetary and investment purposes, much of silver production is a byproduct of mining other metals like copper and zinc. That means supply doesn't instantly respond to price spikes. Even if silver demand surges, mining output can't pivot overnight. Now, layer that with industrial demand. Silver is essential in electronics, solar panels, medical technology, and energy infrastructure. These industries don't slow consumption just because investor demand rises. They need the metal to function. So when investment flows increase, they stack on top of existing industrial demand. This layered demand structure tightens supply dynamics faster than casual observers expect. And tight supply often amplifies price movement. Silver's personality is very different from gold's. Gold tends to move steadily during uncertainty. Silver behaves more like an amplifier. It climbs faster in optimism and corrects harder when sentiment shifts. This volatility isn't a flaw, it's a defining trait. For disciplined investors, volatility creates opportunity windows. For emotional investors, it can trigger impulsive decisions. Understanding silver means accepting that movement is part of the asset's nature, and right now, that movement is attracting attention from investors who see both risk and potential. Step back even further, and you'll see the macro backdrop shaping this rotation. Global economies are navigating elevated debt, shifting interest rate expectations, and persistent geopolitical uncertainty. In environments like this, tangible assets regain psychological importance, not because they generate yield, but because they exist outside financial promises. Silver's dual identity, industrial necessity plus monetary hedge, makes it especially attractive during transitional economic periods. It appeals to manufacturers, investors, savers, and collectors simultaneously. When multiple buyer groups converge, markets notice. One of the most underrated forces in markets is accessibility. When participation barriers rise, investors seek alternatives. Gold hasn't lost its role, but its price has made entry more selective. Silver democratizes access to hard assets. It allows broader segments of the population to hedge purchasing power and diversify outside traditional financial systems. Historically, expanded access has catalyzed powerful commodity cycles. Silver's accessibility isn't replacing gold, it's reshaping participation. And participation drives liquidity. Liquidity drives momentum. Momentum drives narrative, and narrative influences behavior. So how do you interpret whether this gold to silver rotation has staying power? Watch behavior, not headlines. Monitor the gold to silver ratio. Compression often signals relative strength. Retail bullion demand patterns. Industrial silver consumption trends. Dealer inventory movement. Price behavior during economic stress. Markets communicate through action. Those signals reveal whether silver's role is expanding or stabilizing. The dramatic move from gold to silver isn't about declaring a winner. It's about recognizing how accessibility, psychology, and structural forces interact. Right now, silver is emerging as the practical gateway for a growing class of investors seeking tangible value, whether this becomes a lasting cycle or a transitional phase. The shift itself reveals something essential. Markets evolve when human behavior meets economic reality. Investors who understand that evolution position themselves with intention instead of emotion. If this breakdown helped you see the mechanics behind the headlines, subscribe for more deep dives into financial structure and market behavior. And I want to hear your take. Do you see silver as an opportunity, a hedge, or a reflection of changing economic conditions? Drop your thoughts below. Thanks for watching. I'll see you in the next video.